have taken us through many surprises since 2014. After unprecedented highs and abrupt downswings, the stock markets are now witnessing a sentiment of euphoria. While some economists call it a bubble, others call it a stable high which is here to stay. We have our special correspondent Ankit Doshi to answer some critical questions about the euphoria in stock markets. So Ankit, what has made our stock markets so attractive this year, considering that the corporate earnings have remained muted and the economic growth has slowed?
The humongous flow of money, in other words liquidity. Mutual funds have pumped in more than 82,000 crore in the first 9 months. So this 82,000 crore rupees, or roughly 12 to 13 billion dollars of inflow, is a record number. In addition, foreign investors have remained net buyers of Indian equities, albeit with some amount of selling in recent months and a slightly lower quantum than in previous years. But still, they remain buyers. So that has supported our markets as well. Since December 2016 lows, benchmark indices have risen 25 to 30%. And a lot of it has been driven by consumer-centric sectors. Just to give you an example, HUL or Hindustan Unilever, the stock has risen nearly 61% since the lows in December 2016. And the BSE FMCG index, a gauge of fast-moving consumer good companies, has risen 33% in the same duration.
Well, in view of the recent investment patterns, are we looking at a diversion of funds from corporate sector to stock markets? And also considering that we are now in a phase of bull run, would it be safe to invest in stock markets for a long term?
Equity is a risk instrument, and it doesn't ensure any safe returns, or it doesn't guarantee any safe returns, be it long term or short term. Looking outside of that perspective, valuations do not look stretched according to various market analysts and strategists. There is still some room for Indian markets to rise from this or the current levels. Liquidity is driving everything at the moment, while investment sentiment and fundamentals are following that money. Corporate earnings, along with key economic and political developments, will indicate the future movement towards equity or stock markets. The street has already discounted fiscal 2018 earnings and are instead looking for an improvement or a jump in fiscal 2019. And that is what is supporting valuations at the moment, and hence there is some room according to analysts and strategists.
Well, have stock markets become a preferred destination for money-smart category of investors like private equity players?
If you look at the past returns and the humongous amount of money that has flowed into equity, it clearly is the most preferred asset class vis-a-vis gold, real estate, fixed income products. Household savings is gradually flowing into equities, and with growing number of SIPs or mutual fund investments, you may perhaps see equities leading all the other asset classes in the near to medium term. I would quantify that as roughly 6 to 12 months, or probably even 18 months.
Well, even though the euphoria around investment in stock markets is nothing new, this is one of the very few times when the euphoria is happening when the economy is on a slowdown. Well, as far as the safety in long-term investments is concerned, this definitely is a speculative matter. But when it comes to short-term investments, this definitely is one of the best times to invest and reap rewards. Thanks for being with us on VCCTV. Keep watching this space for more updates.